What if someone told you that in the past 14 days, it wasn't just a trade war that began, but a methodical dismantling of one of the most influential economies in the world? Not with shouting, not with threats, but with silence. And not on the front lines, but in the container terminals of Shanghai, the assembly halls of Detroit, the transport routes between Los Angeles and Arizona. This is not a dispute about tariffs. This is dismantling. Right now, container ships are waiting in queues from the ports of California to East Asia. Amazon is canceling orders while they're still in transit. And China? It remains silent. It doesn't argue. It acts. What you're witnessing is not a conflict. You're watching a demonstration of power, the ability to press on the weak points of the American economy as precisely as one presses on microchips along Ford's assembly lines. On April 3, 2025, Beijing signed a low-profile but staggering order in terms of its consequences. All Chinese state-owned airlines were to immediately freeze purchases from Boeing. No press conferences. No announcements. Just stop. In 48 hours, the company's market capitalization collapsed by $28.4 billion. Silence kills louder than any sanctions. This decision didn't just hit aircraft deliveries. It was a signal. One more step, and we'll strike those who depend on us in their most vulnerable spot. Boeing is a symbol of American power, of industrial supremacy. And it's precisely such symbols that are chosen first in trade wars, because the pain of symbolic defeat resonates on all levels. But airplanes are just the tip of the iceberg. On April 1st, the Trump administration imposed a 145% tariff on the import of more than $300 billion worth of Chinese goods, an assault equivalent to blowing up a bridge during an evacuation. 3 days later, exports from China to the U.S. dropped by nearly half. More than 71,000 containers were stuck in Chinese ports. The supply chain shattered, not accidentally, not due to a storm, but deliberately, coldly, and efficiently. On the U.S. West Coast, collapse. In Los Angeles, 27 ships waiting to be unloaded, with an average delay of 96 hours. The price to ship a single container jumped from $1,950 to $6,820, a 250% spike in just 10 days. Chinese freight carriers are massively refusing deals. It's impossible to calculate tariffs when the rules change in the middle of the ocean, says a representative of Sotrans Logistics. By April 6th, the top 5 Chinese logistics companies had fully suspended bookings of cargo bound for the United States. The problem isn't just about money. It's about trust, legal risks, and a complete loss of predictability. More than 1,200 factories in Guangdong province halted. In warehouses, finished goods, packed and labeled, but going nowhere. Literally. And this is no longer just about logistics. It's about an economy turned completely upside down. According to U.S. Customs data, imports from China to the United States dropped by 34% in just the first half of April. Amazon began mass cancellations of shipments. Five Below announced the cancellation of orders totaling over $67 million. Nearly 11% of its entire quarterly inventory. What does this mean for the consumer? Already, rising prices, shortages, frozen warehouses. The U.S. Consumer Confidence Index has plunged to 75.1, the lowest level since 2022. But this is only the beginning. The real blow hit the auto industry. On April 11th, production of the F-150 Lightning at Ford's Michigan plant was halted. The reason? Lack of microcontrollers from Shenzhen. GM's Tennessee plant reduced battery production by 60%. 41,000 unfinished vehicles in 1 week. Losses, $1.6 billion. Layoffs, disruptions, delays. Do you know how many Chinese components remain in each American car? At least 24, from basic chips to rare earth magnets. And when just one of them doesn't arrive, the entire line stops. 2,000 workers go home. That's how an industry built on precision collapses. By mid-April, the cost of shipping a 40-foot container from China to the United States rose to $7,300. The price of new cars jumped by $2,600 in just 1 month. The used market isn't far behind, a 4.1% increase in 1 week. And now consider this. U.S. dealers have begun deliberately reducing inventories by 30% to avoid losses. And what about the alternatives? Vietnam is overloaded. Ports are operating at 94% capacity. India has a weak transport infrastructure. Everything depends on slow highway trucking. In Mexico, border delays. In Laredo, trucks wait 12.5 hours. Speed? Reliability? For now, these are still just myths. Even giants like Tesla and Apple are struggling. Apple reports a 14% defect rate at its new facility in Tamil Nadu, higher than in Shenzhen. Replacing China? Possible. But we're already paying the price. Shipment failures, lower quality, increased production costs. On April 12th, China restricted the export of two critically important rare earth metals, dysprosium and terbium. The United States depends on China for 78% of these materials. That means delays in defense projects, setbacks in missile system production, shortages in electric vehicles. GM, Ford, Lockheed, all are sounding the alarm. No replacements, no logistics, no time. Even under the most optimistic scenarios, mining in Australia or Canada won't cover the shortfall before the end of 2026. Do you understand what this means? This is no longer about assembling cars. This is about controlling the future of technological development. And while Washington debates new tariffs, Beijing is silently cutting off the oxygen. Everything we are witnessing right now is not a flare-up. This is the new reality. Automakers are already redrawing their production maps. Tesla is accelerating assembly of the Model 3 in Berlin. Toyota is redesigning models to eliminate complex components. And Stellantis is shifting some models to assembly in Mexico. But all of this is emergency response. And every new contract, every new supply chain, means months of losses and billions in expenses. And here is the result. The price of a new car in the United States is already $47,770. The average increase over a month, $2,600. And that's without factoring in future shocks. But the main threat is not in the containers, not in the shortages, but in the numbers coming from Wall Street. The share of foreign holders of U.S. bonds is the lowest since 2011. China is beginning to offload American debt, slowly, silently, methodically. And if the goods front is already cracking, then the next blow will be to the dollar. And then the question won't be, what have we lost? But what do we have left? Share your opinion. How much longer will this strategic pause last before a true economic collapse begins?